take a breath. No, seriously. Take a breath and step away from the 1-minute chart. Because while retail traders are panicking over every red candle, the smartest money in the world is doing something very different. They are not staring at the floor. They are staring at the ceiling. And what they are realizing is deeply uncomfortable for the system. I came back because the story has changed. Not on your screen, but underneath it. It is Tuesday, February 10th, 2026. Gold is holding above $5,000. Silver is violently swinging between $72 and $80. And while social media is screaming crash, institutions are quietly asking a very different question. What if this isn't the end of the bull market? What if this was the final shakeout before the real move? Because history tells us something very clear. The most violent drops do not happen at the end of a cycle. They happen right before repricing. We need to talk about why. We need to talk about Merkin Capital. We need to talk about Daniel Oliver. Daniel Oliver is not a YouTube influencer. He is not a trader chasing clicks. He is one of the very few analysts who studies monetary collapse as a mechanical process, not an opinion. And his latest thesis is explosive. He is not calling for $6,000 gold. He's not calling for $7,000. He is saying that the mathematical equilibrium price required to stabilize the global system is between $8,300 and $12,500 per ounce. That sounds insane until you look at the math. And this is the math you will never hear on financial television. Every fiat system eventually reaches a breaking point. Debt becomes unpayable. Confidence evaporates. And at that moment, central banks are forced to restore credibility. How do they do that? They back their liabilities with hard assets, not 100%. That never happens. But history shows something very consistent. To stop a hyperinflationary spiral, central banks must back between 1/3 and 1/2 of their balance sheet with gold. Now look at the Federal Reserve today. Trillions in printed money, trillions in bank reserves, reverse repo liabilities, unrealized bond losses. If you take that entire liability stack and require even 33% gold backing, gold must be repriced above $8,000. If you require 50%, as happened in previous crises, gold moves above $12,000. This is not speculation. This is division. Total liabilities divided by ounces of gold. That is the number. So why does this matter now? Because the Federal Reserve is trapped. This is the part nobody wants to talk about. The Fed is losing roughly $245 billion per year in operating losses. Why? Because they printed trillions to save the system, and now they must pay 5% interest on those reserves to prevent inflation from exploding, while their assets only yield around 2%. They are paying 5%. They are earning 2%. That gap is a death spiral. Raise rates, and the losses explode while the Treasury drowns in interest payments. Cut rates, and inflation goes vertical and the bond market collapses. There is no painless exit, except one: revaluation. You take the gold sitting at Fort Knox. You mark it from the fictional $42 official price to the real market price. Instantly, the balance sheet heals. The Treasury stabilizes. The system survives. But the dollar is devalued against real assets. That is the trade. Which means gold at $5,000 is not expensive. It is cheap. And silver at $80? Even cheaper. So the real question becomes, if fundamentals are this strong, why did the market crash? Who sold? Who was insane enough to dump billions in paper metal at these levels? We found the answer. It was not China. It was not a government. It was not some shadowy conspiracy. It was one man, a whale, a gambler, a Chinese billionaire trader operating out of Gibraltar, completely off the radar. He is the largest short seller in the history of the silver market. Approximately 30,000 contracts, that is 450 tons of silver. Let that sink in. This is not a bet against silver. This is a spread trade. He is long gold, very long. He made billions riding gold from 2,000 to 5,000. But he believes gold is money, and silver is just an industrial sidekick. So he shorted silver to bet that the gold to silver ratio would explode. And for a moment he was right. Silver collapsed from 121 to 72. On paper, he is up nearly $300 million. But here is the problem. He does not own the silver. He sold promises. He sold paper. And paper has a margin limit. Governments can suppress markets forever. Traders cannot. If silver ticks back to $86, his profits evaporate. Margin calls begin. And to close a short position, you must buy 450 tons in a market with no metal. That is how short squeezes are born. And while he is celebrating paper profits, something far more important is happening in the physical market. Turkey stepped in, quietly, aggressively. In January alone, Turkey imported 273 tons of physical silver. That is nearly 9 million ounces in 1 month. This is not speculation. This is a nation that understands inflation buying real money. They didn't panic sell. They said thank you for the discount. This is what a physical floor looks like. Paper floors break. Physical floors drain vaults. And every time silver touches 72 or 80, real buyers step in. Turkey, India. Private wealth funds, they're calling the bluff. And now add another layer. On January 1st, China locked down exports of critical minerals, including silver byproducts. Supply from the East is shrinking. Demand from the Middle East is exploding. This is the anvil and the hammer. Paper price caught in between, which brings us to the danger zone. Next week, the Lunar New Year. Asia shuts down, liquidity disappears, markets get thin. This is when algorithms hunt stops. We could see extreme volatility. We could see one final flush, but understand what it would be. Not fundamentals, not demand destruction, a seasonal liquidity vacuum. And when China returns, they will see cheap silver and treat it as a gift. This is how the spring coils. So here's the verdict. The crash was not real, it was manufactured. Driven by one billionaire and paper leverage, physical demand is at record highs. Supply is restricted. The whale is trapped. Gold is mispriced. Silver is suppressed. And artificial prices do not survive in a world of real shortages. The price is fake. The floor is real. And the squeeze is only a matter of time.
Hello my dear friends, welcome back today my new video after the long time. So friend, take a breath, no seriously take a breath and step away from the 1 minute chart because well retail traders are banking our every red candle. The smartest money in the world is doing something very different. They are not staring at the floor. They are staring at the ceiling, and what they are realizing is deeply uncomfortable for the system. I come back because the story has changed, not on your screen, but understand it is Tuesday, February 10th, 2022. Gold is holding above $5,000. And well, social media is screaming crash. Investors are quickly asking a very different questions. What if this isn't the end of the bull markets? What if this was the final checkout before the real move? Because history tells us something very clear: the most violent drops do not happen at the end of a cycle, they happen right before rebasing. So friend, this is my new video and my new information after the long time. So friend, please like this video and subscribe this channel for more videos. Thank you so much.